Hey, this is Jim. People have asked me over the years to do a sort of retrospective on the 1929 stock market crash, the period building up to it, and then the crash down in the 1932 low, and sort of dissect it based on everything I use in the behavioral analysis model. If you guys have followed me for any amount of time, you know that I developed my entire model by studying the 1929 stock market top. So all of the trading activity into that top and then the crash coming out of the other side. And then also 1986 through 87 and that crash. And then what I did once I thought that I'd seen some things that were sort of repeatable based on human emotion, human nature, human behavior, I drilled down into the lower term time frame. So although I developed everything off of daily bars, which is what you're looking at right now, and then dove down into hourly price data for this 29 period and also 87. Once I thought I noticed something that was something I could use in the future, at that point I drilled down to 5-minute bars, 1-minute bars, and then lower, and wanted to make sure that I observed the exact same things happening at those fractal levels, which I ended up seeing, convincing myself that this was useful, and here we are today. So I'm going to show you guys some of the different elements of behavioral analysis method, some of the things that I use and the tools I use. All of the terminology around my model was developed for my own consumption. I never planned on sharing any of this with the public. And then after I went to work for the big fund, and then they encouraged me to start the service, that's when I had to come up with some way to define all this for the public, and I didn't want to reinvent the wheel. It would be too confusing for me to start to call all of these things, by different names. Therefore, some of these names are a little, odd, but I just stuck with my original kind of vernacular. So the first note you notice right here is when I first started to work on this model, it was way back in the late 90s, early 2000s. So trade stations always had data that defaults back 99 years. So I was able to look at, all the way back to 1901. And so there are some hidden retest levels, which are these magenta lines, that you're not going to see on this chart because the point of origin happened prior to 1924. So unfortunately, every year we move forward, we lose another year of this long-term study, but at least we can use what's in front of us. So the hidden retest levels, for those of you who aren't familiar with it, to me is the most important part of any discovery I've ever made. If you study technical analysis, you know that price gaps hold meaning, and that if it pays to continue to keep your eye on price gaps for price fills of those gaps. The hidden retest levels turn out to be, I believe, something, the way I describe it, at least to people that ask me for an explanation, is it's sort of an area where you have an inflection point where either the bulls are going to overtake the bears, or the bulls are going to resume an uptrend, or vice versa. Bears are going to be overtaken by bulls, or bears are going to resume a downtrend. And at that inflection point, you need to have a certain amount of what I refer to as bull versus bear battleground. So you need to see some indecision and some struggling and fighting back and forth to try to determine who the true winner's going to be eventually. And as a rough rule of thumb, if you guys have followed me for a while, you know that I use Fibonacci time extension. And so basically I look at the length of time that the uptrend requires prior to the break point. And then I like to see like ideally a 38% of the amount of time spent in the bull and bear battleground when compared to the time that it took for the price move to create an uptrend line and then finally break down through that uptrend line. Same rules apply to downtrends. So let me start with one of the most simple things that I noticed that you can apply to powerful price moves to the upside or to the downside when you start to see trajectory change in price trading activity. So you can see here the sort of the trajectory of price if we were to draw a channel or anything else, and price is moving off of this kind of primary uptrend line here. Point of origin 1924 low, then you have some nice contact here in 1926, again in 26, 27 here, and kind of rattling around in 27. Then the trajectory starts to change a little bit. So what I've found is useful, and this doesn't require much time, nothing incredibly scientific about this, but when you look at a prolonged uptrend or downtrend and you can identify the trajectory of that trend, I label that as trend 1 or trajectory 1, T1. Then when you start to lift to a different trajectory, I'll label that as trajectory 2, T2. And then as it does it again, a steeper trajectory, I label that as trajectory 3. And then you can see on a blow off top, your trajectory 4 is going to be even more steep than your trajectory 3. You guys will also see you can have a trajectory 1, trajectory 2, trajectory 3 increasing in steepness and slope, and then trajectory 4 sort of failing to meet the trajectory of 3. So it could have looked something like that even. But the importance is, especially in a blow-off top like this, where trajectory 4 is the steepest slope of any of the series, you can use that break as your sort of short or exit point. Now, it's also pretty common to not see the full vibration sequence, my A, B, C, D, E sequence happen on a break. So as a matter of fact, if we look at this, you can see that this technically leaves behind a hidden retest level that wasn't revisited for years and years and years. As a matter of fact, we can take a quick look at this before I move to the next item here. So you guys know the hidden retest level is created when you have a fast market break of an uptrend or a downtrend line. And again, you don't see the bull versus bear battleground. You need to see the A, B, C, D, E vibration sequence take place. And if you at least don't see a quick B, so your break of this uptrend line is your A. If you don't see the B, the old timers called it a kiss-back, then you can really fall away quickly, but it leaves behind, what I refer to as a hidden retest level. There's no apparent price gap. If you were to look at this, you can actually see the wick bottom here and a top right there. So there isn't a price gap for you to study based on regular technical analysis, and this was sort of the magic of my hidden retest levels. So if we look at this thing, the entire crash from the 29 top into the 32 low takes place, and I'll show you how many years it takes before you revisit this hidden retest level. Hidden retest levels, let's call it 365. So here we are, the hidden retest level is hit in 1954. So that's how long it took, but that's how important these are to follow. So anyway, again, the takeaway here is that the steeper trajectory 4 is into a blow-off top, the more likely that it's going to have a very sharp trend break and not spend the normal time going through the vibration sequence here. So anyway, that's your takeaway there. The next thing here that was sort of the most important discovery from the 1929 stock market crash is being able to incorporate the hidden retest levels into the crash. So you not only have a blow off top, and if you were to apply Bollinger Bands or moving averages and things like that, you guys know you'd see a huge disparity between where price was currently trading and where, let's say, the 200-day, this is a daily price bar chart, where the 200-day moving average would have been sitting. So you already would know that there was a lot of risk involved in the Dow Jones Industrial Average because of this enormous gap. What you wouldn't know is that there was also this hidden retest level sitting right down here that also coincided with this longer term uptrend line off of the 1924, 26, 27 lows, this white line. So what ends up happening is the stock market crashes all the way down to hit this hidden retest. Hidden retest levels are always fast market attack levels. So it's very uncommon for price to just slowly stair step down to a hidden retest level. It's more common to see this violent price move in an attack. So that's what you had. Once a hidden retest level is hit and contact is made, that level turns into what I call a vibration level, and we expect to see the ABCDE vibration sequence. So as you move up here, the fact that price was not revisited right here and retested in, that would have been 1928, when this breakout took place, and there was so much sort of FOMO behind this breakout when compared to the May of 28 high right here. So this is August of 1928, and you just see that tremendous FOMO. That leaves behind this hidden retest level at, let's call it 215.75-ish, and you see this tremendous crash. Well, the move up is your A. This violent attack of the hidden retest level is your B, and then this would be your C, A, B, C, D, that would be your E. So if we move forward here to the next couple things I have on the chart, this is a speed line, you guys know. The importance of leaving the speed line on here will come when we talk about this next price move, this bear crawl down to this low. Here's the reason why. This downtrend line right here was created from the first move down off the top, the bounce high, and then a lower low. So this is a valid trend line, right? 1, 2, 3, ABC, whatever you want to say. So this is a valid trend line. Well, typically in a crash, you would see price eventually crash down to and attack a speed line. But keep in mind, this speed line is created off of this daily bar chart. In order to revisit it, it would have to be revisited at some point here. Well, once you're below a zero line, all right, you obviously know that the odds, which you were right here basically in January of 1930, you already, if price would have moved down to attack the speed line, you're already below the zero line. So odds favor the fact that a stock is not going to zero most of the time, or especially an index like the Dow Jones Industrial Average. So at that point, what you would know is you would know that although you may leave this on the chart, you know that price is much more likely to do what I call a bear crawl down this downtrend line. So you've got a downtrend line, you saw your price break right here, and then that means that what was resistance, right, the downtrend line was resistance, becomes support. We all know that. The interesting thing about using a downtrend line to anticipate what I call a bear crawl in price is that the more time that's spent trading sideways off of this downtrend line, we know the greater the air pocket that we're building if price is going to revisit that downtrend, which now in theory is support, right? Resistance becomes support. So what happens is you have this very violent move back down. It makes contact on this downtrend line. That's in my work called a bear crawl. And if price were to have continued down that downtrend line, it would have looked like this. What happens instead is because we have a hidden retest level sitting in between where price is currently trading right here and where it would need to move down in order to continue this bear crawl on this downtrend line that was attacked right here. We're, instead of anticipating a continuation of the bear crawl, we're anticipating contact on the next hidden retest level, the downside, followed by vibration. So that's what you get. You get a very sharp move down, but instead of attacking the downtrend line and continuing a bear crawl, it hits the hidden retest level. That's a sticky level as far as vibration following, and that's what you get. You get vibration right here. Then you get another violent move down. Again, hidden retest levels are fast market attack levels, and then it's followed by vibration again. And then right here, you get another attack of a hidden retest level created way back in 1926. At this point, you're trading into May of 1931, and then followed by vibration there as well. So also what you have at this point is, whereas we use this down, up, down sequence to create this first downtrend line, once we had this deep bounce followed by a lower low, right? You have this low. As soon as you have a bounce and a lower low in price, that's when I consider a trend line to be valid. I know a lot of people will jump the gun, and prior to a break of this low, they'll start to draw a downtrend line off of this. The problem there is, I mean, it could move on to a new all-time high at this point, and you've drawn a completely invalid downtrend line. I'm not going to fight anybody on that. I know a lot of people like to use those, and they may find that effective, but that's just not part of what I do. I need to have that down, up, lower low to snap in line my downtrend line, because it becomes really important in my work, as you can see from this beautiful bear crawl that the Dow saw into 1931, and then setting up for the 1932 low. So the next thing I want to show you guys, which was really important here, is this beautiful short selling opportunity, if that's what people would have been into at the time, or at least exiting if they had bought back in. Is you guys can see on this trend break of this longer term trend line that it again dates back to 1924, 26, 27 touch points. Obviously, it's been touched enough and important enough and saw turning points to where it's a valid uptrend line and it has meaning. What happens here is on the fast market break right here, I didn't include the hidden retest level, but that would have been a hidden retest level sort of between here and here. I just snapped in place the vibration level. So you get your price break, that's your A. You move back up again, B. You have vibration at 233. It was a hidden retest level, now it's vibration. So you have your A, B, C, D. Now we're anticipating an E wave, and that's sort of minimum vibration sequence, the minimum bull versus bear battleground that I need to see in per my methodology. It doesn't mean that you can't continue. You guys will go find examples of A, B, C, D, E, F, G, H, and then it'll be back up here. And there'll be some other reasons why it's revisiting, but there's no rule that the E is the terminal, leads to the terminal trending move. But if a market's going to strongly resume a sharp trending movement, and so if the move preceding the vibration sequence is sharply trending, the odds are huge that all you're going to need to see is this A, B, C, D, and you're going to want to sell this E. I'll drill down and show you guys what I mean by this Wilt candle. Wilt just means Wilt Chamberlain, the famous 7-foot+ basketball player. So it just means a tall candle. So what you want to see on for a sell or a buy signal off of vibration sequence is the A, B, C, D, and then on the E you want to see what I call a Wilt candle, meaning a tall candle. You want it to paint through from open to close. You want it to paint through the vibration level, and you want it to close, in this case, since we're tracking an E wave within a downtrend, you want it to close at the bottom end of the range. Now there's a little wick on the bottom of that daily range, but you can clearly see that the majority of the trading activity is below that vibration level, and you had a really nasty prior day bar, upper range to lower range close, and then sort of if you were to combine these 2 days as a continuation, you clearly cut right through that 233 vibration level. So at that point, it's an easy short with a stop above the D wave. And in this case, that ended up leading to the further decline all the way into the 1932 turning point low. In the 32 turning point low, the takeaway here, there's a couple things. Number one, we see this beautiful bear crawl. And again, the more time that you spend trading horizontally away from this trend line, the more vicious the move back down to continue the bear crawl is going to be. So if you're trading, let's say, a 1 minute chart or a 5 minute chart, and you're observing all these things. It might be something you can use if you're trading very short-term calls or puts, because you're anticipating a violent move of X amount to revisit the downtrend line on the bear crawl. So you not only know that on a break of a low that the move should be violent, but you know about what your price target approximately can be, and that it's going to happen very quickly. Again, it's useful for trading short-term options and things like that. So here's the other important takeaway here on trying to predict when this 1932 turning point low is going to happen in the Dow. At this point, the market was down a full 90%, somewhere around there. But here's what's important. Just like I mentioned here on the speed line, to where if you're tracking a speed line and you notice that the price target on an attack of a speed line would be unrealistic, and in this point below zero, and that tells you to go and concentrate on a bear crawl of a downtrend break and sort of mainly discount or ignore the speed line at that point. Might be worth keeping an eye on until it dives below the zero line. Same thing happens here in this valid downtrend. So you've got your down 50% bounce, and then you make a lower low. As you continue to dance down this bear crawl, down this downtrend line, at some point, you have this zero line sitting here. So if I extend this out to the left, then you know that if this bear crawl would have continued right here, you would have made contact at about the 55 level in the Dow. And then once you get to this point, if you were to attack the downtrend line, you're below the zero line. So again, once any of these tools that you're using during the trading process dive below the zero line, you have to start to place the odds on the idea that that's not going to happen, and you start to look around for other tools you can use. What I like to do is I like to look for a third contact point if and only if a price is situated to where it can dive below the zero line. I don't want to look at third contacts all the way down because it's useless. It can happen over and over and over again and break the third contact. But again, if we're in a situation here where revisiting a downtrend would carry price below the zero line, I want to look back in time at two points of contact and focus on a potential third contact. That's what we end up having right here. And it turns out that works pretty well in anticipating this turning point low again in 1932 as the Dow bottoms at the 40 level. So up here at the top, we were at 380, I believe. Yeah, 382. Yeah, 382. And, you're moving all the way down to this, 40 level. And again, this is the 1929 pre-crash top. This is the July 1932 low. And again, my note here, if the bear crawl continues, the Dow Jones Industrial Average trades below zero. Therefore, we assume odds favor a third contact low, as opposed to a continuation of the, what I call a bear crawl. So again, you guys, I made up, these terms just for my own consumption. Some of them sound goofy, but I just did not want to have to come up with new terminology for the public because I have a walnut-sized brain, and that's just too much for me to handle. It's easier just to stick with sort of the muscle memory of what I learned over a multi-decade period. Anyway, that's what this looks like, you guys. If you you'll also notice there's a better speed line that helped in measuring where price would potentially move to in this melt-up move. And if I could take you back to 1901, I could show you a really interesting speed line overhead that was attacked right into this 1929 stock market top. But even looking at the chart we have in front of us here, off of the 24, this is actually January of 25 high, and call it November of 1925 high. You can see how sharp the move was off of this price breakout and attacking that speed line. And then you can see where you had rejection and all this noisiness. And then again, on this breakout here, if I could carry you back in time, you'd see that there's a primary speed line that was attacked within this sort of huge expanding megaphone melt-up fractal. So that's what that looks like. Down the road, I'm going to do the same thing for the 1987 stock market crash. I'll show you guys. There's a lot more detail available there. I'll show you guys, in addition to daily bar, I'll show you hourly and go down to the 5-minute. I may dive into the 1-minute, but really the 5-minute expanding megaphone crash fractal is super interesting, and price attacks the speed line, perfectly. And then you have this combination of an expanding megaphone crash fractal with these hidden retest levels that are way, way below where the market was currently trading into that 87 top, and you had the speed line attack as a price target. So a lot of useful stuff, and you guys can use this in currency markets, commodity markets. It worked great in the crude oil crash that actually carried price sub-zero. Minus $46, I think it was. But so you can have an overthrow of these speed lines, just like I showed you right here, where price went up through that speed line. But it's at least a target you can use that's usually a more aggressive target than most people will have out there using regular technical analysis and things like that. Again, never underestimate, no matter how crazy hidden retest levels look, never underestimate the fact that based on what I've studied over the years, they're revisited at some point in the future. And so, you need to lean on some other tools as far as the timing element. But I think it pays to always have in the back of your mind sort of what those hidden retest levels look like and the result. So if you guys ever go back and study this, you can drill down to a lot of other information too. Here's another downtrend line. You can look at the change in trajectory as you move into this low, the whole T1, T2, T3, T4, and you'll notice a lot of, pretty interesting stuff. From a technical standpoint, you can make an argument this is sort of a left shoulder, that the low is sort of ahead, and this is sort of a sloppy extended right shoulder before a breakout of a neckline that would look, something like that. So a lot of interesting stuff if you go back in time. Here's the other thing, and I'll wrap up, is don't let people convince you that the Dow Jones Industrial Average, because it's only comprised of 30 stocks, is a worthless index to look at. It's the greatest index, and it's the only index actually to study super long-term price activity, because SPY won't get you back into the same period that you guys are looking at right now. The other thing is, although it's only comprised of 30 stocks, I mean, they're the monster industrial stocks of the most powerful economy on planet Earth. And I promise you, it's worth your time to study the Dow, even if you're building algorithms. I bet you that you will find some nuances that help you in building systems and in understanding, technical analysis, behavioral analysis, whatever. The other thing is, I personally love to go back and look at pre-computer trading, because what you'll see, even though the market is computerized now and tons of AI and algorithms running, is that they still are mimicking original, authentic human emotion. And then what they're doing is they're exploiting that human emotion to push price a little bit farther in each direction to sort of run stops and exploit fear and greed. But the main moves are pretty much the same moves that you're going to observe going all the way back in time to any chart you can get your hands on, including, by the way, going back into the 1800s and looking at old gold charts, which you can easily get your hands on if you visit your local library, and it's all free. I mean, there's a tremendous amount of stuff that you can study free of charge in the library. That's where I used to spend my weekends, a long time ago when I was trying to figure this stuff out. That's it from my side. Good luck to everybody. Hope that was useful.